10% jump in the VIX, a massive 6% intraday surge in oil, and a major geopolitical ceasefire completely collapsing in real time. Are we witnessing an abrupt end to the tech bull market? For me, it's over. In my view, this was a waste of time. Hello everyone, welcome back to AI Market News. Today is July 8th, 2026, and based on available data across global markets, we're looking at a trading session where geopolitics has completely taken over. Not earnings, not Fed policy. We are seeing a severe recalibration across US and Japanese markets as all of us digest this stark declaration from President Trump regarding the Middle East. Section 1. The Iran deal collapses. To understand today's wild price action, we first need to look at the geopolitical catalyst driving all this fear. Let's walk through exactly what happened, because all of us need to understand this rapid escalation. On Monday morning Eastern Time, Iranian Revolutionary Guard forces attacked 3 commercial vessels transiting the Strait of Hormuz. The U.S. response was immediate. They reinstated the ban on Iranian oil exports. And right after that, the U.S. launched retaliatory strikes against Iranian military targets. According to current market information, these strikes were 4 to 5 times larger in scale than previous engagements. This sudden, aggressive unraveling of the recent ceasefire framework is the core engine behind today's market anxiety. Section 2. VIX spikes and oil surges. Let's move over to the commodities and volatility space to see how this diplomatic collapse triggered an immediate global financial reaction. As we can see in the chart, WTI crude just surged up to 6% intraday. So what's the underlying mechanism here? Well, the Strait of Hormuz is a massive geographic choke point, responsible for roughly a fifth of the entire global oil trade. When military conflict threatens that specific area, fears of a supply disruption immediately price a heavy premium into oil. And naturally, those higher energy costs directly drive up broader inflation expectations for the entire global economy. Now, taking a look at volatility, the graph shows the VIX jumping over 10% to 17.79, up 1.65 points on the day. For those newer to this, the VIX is essentially Wall Street's primary fear gauge. It measures expected market volatility. A sudden double-digit percentage jump like this isn't just a gradual drift. It signals a severe and immediate market shock. It's a rapid dash for portfolio protection as institutional investors brace for even more geopolitical instability. Section 3. U.S. stocks and rising yields. Let's transition over to how U.S. equities and bonds are digesting this sudden spike in volatility and inflation expectations. Based on available data, the equity and bond markets are actually telling 2 slightly different stories right now. As we can see in the charts, the Dow Jones saw a relatively contained drop of about 131 points, or 0.225%, closing near 52,930. But this contained equity loss contrasts sharply with the bond market, where the 10-year Treasury yield climbed all the way to 4.569%. This resilience in the Dow suggests equity investors might be waiting to see if this escalation is just temporary. Meanwhile, bond traders are already pricing in the immediate threat of oil-driven inflation. However, beneath the surface of those broader indices, semiconductor weakness continued really aggressively. The SOX index dropped more than 4%. The crucial underlying mechanism here is twofold. First, investors are rotating out of crowded AI tech trades to lock in profits amidst all this geopolitical uncertainty. Second, as higher expected inflation from oil pushes bond yields up, investors demand more yield compensation for holding fixed-rate debt, and that puts immense downward pressure on high-growth tech valuations. Section 4. Nikkei drops on tech sell-off. Let's bring the narrative home and see how this global ripple effect impacted Japanese equities during today's session. As you can see in the chart, the Nikkei fell a massive 1,437 points to close at 66,819.05. That is a one-month low. But what's particularly telling here is that the index closed right at its absolute low of the day in JST. In technical analysis, closing at the dead low is a very weak signal. It indicates that the selling pressure remained completely relentless right up until the final bell, without any meaningful buyers stepping in. We can really break down this sharp decline into 3 specific headwinds for all of us to track. First, the overnight weakness in the US SOX index, paired with South Korea's KOSPI index tumbling over 6%, severely dragged down regional tech sentiment. Second, the 10-year Japanese government bond yield spiked to roughly 2.850%. That's a 30-year high. When domestic bond yields rise this dramatically, risk-free bonds become so much more attractive compared to volatile stocks. And third, the market had to absorb an estimated 1.5 trillion yen in ETF distribution-related selling tied to fiscal year-end redemptions. That forced a lot of mechanical selling pressure across the board. Section 5, Yen weakens on crisis demand. Next, let's shift our focus over to the currency markets and the unique geopolitical pressures currently weighing on the yen. The graph shows the USD/JPY pair touching 162.50 amid these Middle East tensions. This completely pushed the dollar back up into the low 162 range after some of the recent dips we've seen. And this brilliantly illustrates a dynamic known as crisis dollar or petrodollar demand. The underlying mechanism here is actually pretty straightforward. During major geopolitical or energy-driven crises, global capital naturally flows into the US dollar as a safe haven asset. Just yesterday, the dollar had dipped against the yen on rumors that the Bank of Japan was tightening. However, this sudden wave of crisis-driven dollar buying completely overpowered those local Japanese monetary policy rumors today. Still, currency traders remain highly cautious, knowing full well that sudden government intervention could occur if the yen weakens too abruptly. Section 6. What to watch next. With all these moving parts, let's consult the economic calendar to identify what all of us should be watching next to navigate this volatility. Looking ahead, all of us really need to monitor two major events. Later today at 2 p.m. Eastern Time, the FOMC minutes from new Fed Chair Kevin Warsh's first meeting will be released. That's going to provide vital clues on the central bank's inflation outlook. Then, next Tuesday, July 14th at 8:30 a.m. Eastern Time, the June U.S. Consumer Price Index, or CPI report, comes out. This data is absolutely critical. It will reveal exactly how much of this recent oil-driven inflation is already bleeding into everyday consumer prices, which ultimately dictates the Fed's next interest rate decision. To summarize our explainer today, we are witnessing a fundamental regime shift in market drivers. The dominant narrative has abruptly pivoted away from AI enthusiasm straight into hard geopolitical risk. This leaves all of us with a critical question to consider. Is this week's price action a short-lived scare, or are we at the very beginning of a sustained risk-off period that entirely depends on Iran's next move? Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by NotebookLM AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.